The S&P 500 just pulled back over 10%. Some say it's a healthy correction before the next leg up. Others, they're screaming bear market incoming. But here's the deal. Whichever way this market moves, the Unlocking the Bag family is going to be prepared. Today we're breaking down one of the most powerful market concepts that separates smart money from the herd, sector rotation. If you've ever noticed that tech stocks are hot one year, then suddenly energy stocks are printing money, you've already seen sector rotation in action. It's the natural flow of capital moving in and out of different sectors, depending on where we are in the economic cycle. The goal? Stay ahead of the wave. If you understand which sectors thrive in different market conditions, you can position your portfolio for maximum gains while minimizing risk. So, let's break this down. Markets move in cycles, just like seasons. And just like you don't wear a winter coat in July, you don't want to be overweight in the wrong sectors at the wrong time. The economic cycle has 4 key phases. Early expansion, the economy starts recovering, interest rates are low, and growth starts picking up. Mid-cycle boom, corporate profits surge, consumer spending is strong, and optimism is at its peak. Late cycle peak, inflation creeps up, the Fed gets nervous, and we start seeing market volatility. Recession/bear market, growth slows, earnings decline, and defensive plays start taking over. Each of these phases dictates where the money flows. Let's get into the details. The market as an investor is a game of cycles. Bull runs, corrections, recessions, and recoveries. Each phase brings its own winners and losers. But what if I told you there's a way to position yourself ahead of these moves? A way to rotate your capital so you're always in the strongest sectors no matter what's happening? Today, we're unlocking the bag on sector rotation, how smart investors move their money as the economy shifts. Let's get into it. Sector rotation is exactly what it sounds like, moving capital between different sectors of the market based on the economic cycle. Investors don't just randomly throw money at stocks. They strategically shift between industries that perform best in each phase of the economy. Let's break it down. First up, the recovery phase. This is when the economy starts crawling out of a recession. Unemployment is still high, GDP growth is sluggish, and interest rates are often low to stimulate spending. The Federal Reserve usually keeps policies loose to get things moving again. But here's the key. This is when early cycle sectors shine. The sectors that typically benefit first: consumer discretionary, financials, and some industrials. Why? Because as confidence returns, consumers start spending again on everything from retail to travel to home improvement. Financials also benefit because as borrowing increases and interest rates remain low, banks and lenders see more activity. Industrials, particularly construction and manufacturing, start ramping up as businesses plan for future expansion. Then we enter the growth phase. The economy is in full swing. Unemployment is falling, corporate earnings are booming, and GDP is expanding. This is the time when risk is rewarded, and investors look for high growth opportunities. So, which sectors dominate? Technology, crypto, communication services, and more cyclical industrials. Why? Because businesses and consumers have money to spend. Tech thrives because innovation is at its peak. Companies are investing in new products, software, and infrastructure. Communication services benefit as advertising and media spending increase. Industrials continue to grow as businesses scale operations and demand for materials surges. This is when momentum is your friend. Now, here's where things start getting tricky. The market peak. Growth has been great, but inflation is creeping up. Interest rates may be rising, and cracks in the economy start to show. The best plays now? Energy, commodities, and defensive sectors like healthcare and consumer staples. Why? Because when inflation spikes, commodities like oil, metals, and agriculture tend to outperform as their prices rise. Energy stocks benefit from higher demand and supply constraints. Meanwhile, defensive sectors like healthcare and consumer staples, offer stability because people will always need medicine, food, and essential goods no matter what the economy is doing. This is when investors start getting defensive and looking for safer plays. Then comes the recession phase, the dreaded downturn. Economic activity contracts, unemployment rises, and stock markets take a beating. But guess what? Smart investors rotate into safe haven sectors like utilities, healthcare, and bonds. Why? Because in a recession, people cut back on luxuries but still need basic services like electricity, water, and healthcare. Utilities provide steady cash flows, making them attractive during uncertain times. Healthcare remains strong because medical needs don't stop during economic downturns. Meanwhile, bonds, especially government bonds, provide stability as investors flee from risky assets. So what's the takeaway? Sector rotation isn't about chasing trends. It's about understanding how money moves through different industries as the economy shifts. The key is being positioned in the right sectors at the right time, not just blindly holding on to stocks that thrived in a previous cycle. And one more thing, keeping some cash on the sidelines is always a smart move. When opportunities arise, whether in a bull or bear market, you want to have dry powder ready to deploy. Because at the end of the day, the market will always move in cycles, and the real winners, they're the ones who rotate ahead of the game. One of the biggest mistakes retail investors make? Going all in and having no cash left when opportunity strikes. If you're over-leveraged in one direction and the market flips, you're in trouble. That's why you always want to keep some dry powder, a cash position you can deploy when the right opportunity comes. If the market crashes, you can buy assets at a discount. If the market keeps running, you can still add strategically without being overexposed. It's all about balance. The game isn't about timing the exact top or bottom. It's about being positioned in a way where you win regardless of the outcome. At the end of the day, the stock market is a game of cycles. Money moves in waves, and if you learn how to ride those waves, you're going to be light years ahead of the average investor. What phase of the market do you believe we're in? And what's up next? If we're heading for a bounce, tech and growth stocks will likely lead the charge. If we're rolling into a downturn, defensive positions will be key. Either way, the bag needs to stay secure. And remember, this ain't investment advice. This is just game. You need to look at your own portfolio and make sure you're not overly exposed in one direction. Smart investing is all about staying ahead of the curve and keeping yourself ready for whatever comes next. If this video helped you level up your market knowledge, smash that like button, drop a comment, and let me know how you're positioning your portfolio right now. And of course, subscribe to stay locked in with the best money moves out here. This is Unlocking the Bag, where we don't just talk money, we talk real money. Tap in, stay smart, and let's secure this bag together. I'll catch you in the next one.